In the intricate dance that is modern monetary policy, central banks must choreograph their moves with exquisite precision. One misstep and the whole performance could devolve into chaos, economies tripping over themselves, markets stumbling into disarray. It's a high-stakes ballet where the smallest gestures carry weighty implications. And in Tokyo this month, all eyes are on the Bank of Japan as it prepares to twirl through a particularly complex routine. The choreographers, led by newly appointed Governor Kazuo Ueda, must negotiate two potentially momentous shifts simultaneously, winding down their massive bond-buying program while also contemplating an interest rate hike as early as July. To the casual observer, these may seem like minor adjustments. Just trim some bond purchases here, nudge rates up a quarter point there, what's the big deal? But in the rarefied era of global finance, such moves are freighted with symbolic and practical significance. They represent potential inflection points after years of economic policies bent toward supporting growth at all costs in the wake of the Great Recession. Governor Ueda finds himself in a devilishly tricky position. The BOJ's years of bond buying have swollen its balance sheet to gargantuan proportions at over $5 trillion. It amounts to well over 100% of Japan's GDP. This has effectively capped long-term interest rates and injected reams of cash into the economy, like an IV drip of investment-grade monetary Gatorade. But with inflation now running stubbornly above the BOJ's 2% target, there are growing clamors to start withdrawing that drip, lest the patient develop a lingering fever. Price pressures are most acutely felt in realms like imported energy and food costs, areas where Japan's export-driven economy has particular sensitivity. So Ueda must navigate a very narrow path. Tapering the bond purchases too abruptly could crash long-term rates and spook markets that have grown comfortable with years of yield repression. But letting inflation expectations drift upward unchecked could instigate a wage-price spiral, the stuff of nightmares for any central banker. Enter the other half of the BOJ's perspective two-step, a possible interest rate hike as soon as July. This could provide a shock of cold water to cap rising prices and re-anchor inflation expectations. It would also give the BOJ some semblance of policy normalization after keeping its main rate locked at -0.1% for the better part of a decade. Yet the trick is that Ueda may want to telegraph the rate hike separately from the bond taper in order to avoid turmoil. In the hermetic discourse of modern monetary theorists, the two actions are considered two different things requiring distinct justifications and guideposts, even if implemented concurrently. So the BOJ chief finds himself engaged in a delicate pas de deux, trying to pave the way for both moves through deft rhetorical footwork. In parliamentary testimony this week, he carefully insisted that a July rate hike remains possible regardless of the bond taper plan. His words were scrutinized like Talmudic verses by analysts trying to divine whether he was overtly signaling an imminent hike or just deflecting yen speculation. Those hoping for clarity were left performers' limbs, contorted shapes requiring long study to decipher their meaning. As a former academic, perhaps Ueda was indeed speaking in purely theoretical terms to preserve all options. Or maybe he was offering a sly wink to those anticipating tighter policy? In this drift kabuki theater of monetary policy, every flutter of the econometrician's fan carries shades of potential significance. For the rest of us in the audience, we can only wait and watch as the choreography unfolds. Some may find the routines esoteric or inscrutable. But we would be wise to appreciate the deftness required, for even one missed step could send shockwaves through the global financial order. This is high economic statecraft conducted on a tightrope, every subtle gesture freighted with consequences. Which makes Ueda's performance all the more riveting to observe. The newly installed governor cuts a remarkably unassuming figure for such a leading role. Bespectacled and scholarly, he appears more like a diligent accountant than a central bank impresario. Yet do not mistake his modest mien for lack of vision or resolve. Ueda has already shown steel in his willingness to pivot from the policies of his predecessors at the BOJ. The decades-long low-rate regimes instituted by giants like Haruhiko Kuroda and Masaru Hayami were designed for a very different economic era. As Ueda has stated, monetary policy must evolve in response to changing circumstances. Those circumstances now include the highest inflation readings in 4 decades. The BOJ's 2% target, once an almost mythically elusive goal amid years of deflation risks, has been emphatically breached for over a year. And even after stripping away volatile food and energy components, underlying price pressures are building across the economy. This has forced the central bank to play a game of expectations framing. By overtly validating prospects for a rate liftoff, Ueda and company are aiming to front-run building inflationary psychology. Like a veteran conductor raising their baton preemptively, the BOJ is cueing the audience to anticipate the shift in monetary tempo before it arrives. Such deft signaling will only grow more crucial as the long march toward policy normalization begins. For while a 25 basis point hike would still leave rates only at 0.15% among the most accommodative in the advanced world, it would mark a profound symbolic break. It would represent Japan's first rate increase in nearly a decade and could open the door to further tightening down the road. Which makes the sequencing and interplay with the bond taper plan so delicate. By trimming their bloated holdings of Japanese government bonds, the BOJ hopes to gingerly relieve some of the downward pressures on long-term borrowing costs that their purchases enforce. Allowing yields to drift moderately higher could help restrict excess investment and cool price pressures. But if bond yields spike too rapidly, it could short-circuit the recovery and incite ruinous balance sheet stresses across corporate Japan and the government's own debt profile. The taper must be deftly metered, like a marathon runner maintaining a sustainable pace. Compounding the choreographic difficulty, the BOJ's dual policy shifts are unfolding against a backdrop of global crosscurrents. The U.S. Federal Reserve and European Central Bank are engaged in their own intricate monetary policy taperings amid stubbornly high inflation. Shifting expectations around the Japanese yen, which has plummeted against the dollar, add another layer of complexity that Ueda must negotiate. All of which underscores the magisterial responsibility now resting on the BOJ chief's shoulders. He is being called upon to conduct perhaps the most delicate monetary reprogramming in modern Japanese economic history. One ill-timed beat could disrupt the consolidating recovery or worse, unleashing bouts of volatility and instability that ripple across borders. It is a daunting task rendered more formidable by the tectonic backdrop. The world is embroiled in a generational struggle over trade and technology preeminence between U.S. and Chinese superpowers. The conflict in Ukraine has upended energy markets and exposed the vulnerabilities of globalized supply chains. Even the weather has intruded, with drought parching agricultural belts and accelerating an alarming rise in food insecurity worldwide. Into this vortex steps Ueda, a central banking mandarin suddenly elevated to the highest planes of global economic leadership. His performance will help determine whether Japan can deftly rotate from the emergency acceleration of the pandemic era to a new, more sustainable rate of growth. Missteps will derail the recovery and undermine the nation's standing as the world's third-largest economy. It is enough to make even the most unassuming bureaucrat anxious. Yet if Ueda's academic pedigree is any guide, he has long training in remaining calm amid escalating complexity. The University of Tokyo-educated scion of central banking technicians now faces perhaps his most consequential differential equation, choreographing the decisive monetary pivot while preserving economic and financial stability.